Now we will talk about the financial management chapter 5. Uh, the heading is that capital budgeting evaluation techniques. I repeat, capital budgeting and evaluation techniques. Methods of appraisals. Investment appraisal method can be divided into two basic areas. One in which no time value of money is taken into consideration. And one in which it is using time value of money while evaluating project is known as discounting. A. Non-discounting methods. There are three methods A, B and C. Non-discounting method and economic value added EVA term as per performance measure. Now we will talk about the discounting methods. What's the key point are urgency, payback period, accounting rate of return. Debt service coverage ratio. V. Discounting methods. net present value. The key point are net present value, probability index, internal rate of return. And see, you already talk about, we are already talk about C. Economic value added EVA charm as a performance measure. We talk about discounting method of appraisal. Now we will talk about non-discounting methods. So first key point is urgency. According to this criteria, project which are deemed to be more urgent get priority, or project which are regarded as less urgent. The problem with this criteria is how can the degree of urgency can be determined. In certain situations, of course, it may not be difficult to identify highly urgent investment. Highly urgent investment. For example, some minor equipment may have to be replaced immediately due to failure. To ensure continuity of production, non-replacement of such equipment may mean considerable losses arising from stoppage in production. It may be fatal in such a case to go detailed analysis and delay decision. of these limitations of the urgency criterion, we suggest that in general it should not be used for investment decision making. In exceptional cases where genuine, genuine, genuine urgency exists, it may be used provided investment outlays are not significant. Now we will talk about another keyword, payback period. Payback period is the most widely used technique and can be defined as the number of years required to recover the cost of the investment. This is easy to calculate but is often calculated before tax and always after accounting depreciation. By definition, the payback period ignores income beyond this period, and it can thus be seen to be more as a measure of liquidity than of profitability. The payback period is the length of time required to recover the initial cash outlay on the project. For example, if a project involves a cash outlay of rupees 6 lakhs and generates cash flows of rupees 1 lakh, rupees 1,50,000, rupees 1,50,000 and rupees 2 lakhs in the first, second, third and fourth years respectively. It it pay, Payback period is 4 years because the sum of cash flows during 4 years is equal to the initial outlay. When the annual cash flow is a constant sum, the payback period is simply the initial outlay divided by the annual cash flow. When the annual cash flow is a constant sum, the payback period is simply the initial outlay divided by the annual cash flow income. Cash inflow. For example, a project which has an initial cash outlay of rupees 10 lakhs and constant annual cash flow of rupees 3 lakhs has a payback period of rupees 10 lakh by 3 lakhs is equal to 3.1 per 3 year. 3.1 by 3. According the payback criteria, the shorter the payback period, the more desirable the project. Firms using this criterion generally specify the maximum acceptable payback period. If this is n years, projects with a payback period of n years or less are deemed worthwhile, and projects with payback period exceeding in years are considered unworthy. projects with long payback period are characteristically those involved in long-range planning and which determine a firm's future. However, they are not yield their highest return for highest return for a number of years, and the result is that the payback method is biased against the very investment that are most important to long-term success. Evolution. Now we will talk about evolution. A widely used investment criterion, the payback period seems to offer the following advantages. It is simple, both in concept and application. It does not use complex concepts and tedious calculation and has few hidden assumptions. Since it emphasizes earlier cash inflows, it may be a sensible criterion when the firm is present with problem in liquidity. It's a rough and ready method for dealing with risk. In in favors in favors projects which generate substantial cash inflows in earlier years and discriminates against projects which bring substantial cash inflows in later years. but not in earlier years. Now, increase tends to increase with maturity. In general, this may be true. The playback criterion may be helpful in weeding out projects. It's a simple both in concept and application. It does not use complex concept and tedious calculation and, and has few hidden assumptions. The limitation of the payback criteria, however, are very serious. It fails to it fails to consider the time value of money. Cash inflows in the payback calculation are simply added with added without suitable discounting. This violates the most basic principle of financial analysis, which stipulates that cash flows occurring at different points of time can be added or subtracted only after suitable compounding or discounting. beyond the payback period. This leads to discrimination against projects which generate substantial cash inflows in later years. To illustrate, consider the cash inflows of two projects A and B. Year 0, 1, 2, 3, 4, 5, 6, 7. Cash flows of A, cash flows of B. You can see here a graph or for year 0, cash flow of uh, cash flows of A is minus 1 lakhs. The payback criteria um, A prefers A, which has a payback period of 3 years. In comparison to B, which has a payback period of 4 years. Even though B has very substantial cash flows in year 5 and 6. Since the payback period is measure of projects capital recovery, it may divert attention from profitability. Payback is harshly but not unfairly. Fairly. Fairly been described as the fish bait test in effective. It concentrates on the recovery of bait, the capital outlay, paying not attention to the side of the fish, the ultimate probability, if any. So it measures a project's liquidity. It does not indicate the liquidity position of the firm as a whole. Which is more important? Accounting rate of return. The account rate of return, also referred to as average rate of return or the simple rate, is a measure of probability which relates income to investment, both investment in accounting terms. Since income and investment can be measured variously, there can be a very large number of measures for accounting rate of return. The measures that are employed commonly in practice are A Y average A Y average income after tax upon initial investment. B B B by average income after tax average upon average investment. C oblings. Average income after tax but before interest upon initial investment. D by by average income after tax but before interest upon average investment. E is equal to average income before income and taxes upon initial investment. F is equal to average income before and income average income before income and taxes upon average investment. G is equal to total income. G is equal to total income after tax but before depreciation minus initial investment upon 2 multiply by years. This method is superior to the payback period. This method is superior to the payback period. But is fundamentally unsound. While it does take account of the earning or the entire economic life of a project. It fails to take decision of the time value of money. This weakness is made worse by the failure to specify adequately to the relative attractiveness of alternative proposals. It's biased against the short-term project in the same way that payback is biased against longer-term ones. This method is superior to the payback period, but it fundamentally unsound. While it does take account of the earning, earnings or the entire economic life of a project. It fails to take account of a time value of money. This weakness is made worse by the failure to specify adequately relative attractiveness of alternative proposals. This weakness is made worse by the failure of specified adequate to relative attractiveness of alternative proposals. It is biased against a short-term project in the same way that payback is biased against the longest term ones. Evaluation traditionally is a popular investment appraisal criterion. The accounting rate of return has the following virtues. It is simple to calculate. It is based on accounting information which is readily available for and familiar to businessmen. It considers benefits or the entire life of the project. Since, since it is based on accounting measures, account measures which can be readily obtained from the finance accounting system of the firm. It facilitates post-editing auditing of capital expenditure. Hukam. While income data for the entire life of the project is normally required for calculating the accounting rate of return one can make do even if the income date is not available. For example, when you to enter indeterminacy of project life, a complete forecast of income cannot be obtained. The accounting rate of return can be calculated on the basis of income for some typical year or income for the first 3 to 5 years. The shortcomings of the accounting rate of returns criteria seem to be considerable. It is based upon accounting profit, not on cash flow. It does not take into account of the time value of money. consider two less investment proposal Y and X. Each requires an outlay of rupees 1 lakh. Both the proposals have an expected life of 4 years, after which their value would be nil. There are two proposals, two graphs, proposal X, proposal Y. You can see there both. Both the proposals with an accounting rate of return measure of 50% look alike from the accounting rate of return point of view. For Project X, because it provides benefits earlier, it much more desirable. While the payback period criterion gives no weight to more distant benefits. The accounting rate of return criteria seems to give them too much weight. There are, as we seen, numerous measures of accounting rate of return. This can create controversy, confusion, and more confusion and problems in interpretation. Accounting income. accounting income. Whatever particular measure of income we choose is not uniquely defined because it's influenced by methods of depreciation, inventory valuation, and allocation of certain costs. Working with the same basic accounting data, different accountants are likely to produce different income figures. A similar problem, though less severe, exists with respect to investment. The argument that is accounting rate of return measure facilities post auditing of capital expenditure is not very valid. The financial accounting system of a firm is designed to report events with respect to accounting period and for profit centers, but not for individual investment. Debt service coverage ratio. Financial institutions which provide the bulk of long-term finance for industrial projects evaluate the financial viability of project primarily in terms of internal rate of return on the debt service coverage ratio. DSCR is equal to sigma n raised to I is equal to 1. In counts PATI plus DI plus II upon sigma n raised to I is equal to 1, I plus LTI I. Debt service coverage ratio DSCR is defined as where PATI is equal to profit after tax for year I. DI is equal to depreciation for year I. Year I. II is equal to interest on long-term loans of financial institutions for year I. LRI is equal to loan repayment installment of year I. N is equal to period over which the loan has been repaid. Looking at the debt service coverage ratio, we find the numerator consists of a mixture of post-tax and pre-tax figure. Profit after tax is a post-tax figure and pre-tax figures means loans repayment installation is a post-tax figures and interest is a pre-tax figures. Oh, it is difficult to interpret a ratio which is based on mixture of post-tax and pre-tax figure. In view of this difficulty, we suggest two alternatives. Alternative 1. Alternative 1 is equal to DSCR. Earning before depreciation interest in taxes upon interest plus loan repayment installment upon 1 minus tax rate. Alternative T is equal to alternative 2. DSCR is equal to profit after tax plus depreciation upon loan repayment installment. While alternative 1 is based on pre-tax figure, alternative 2 is based on post-tax figure. There is one more difference. Alternative 1 assumes that the interest and loan repayment obligation are of the same order and focused on the ability of the firm to meet these obligations jointly. Alternative 2 assumes that the interest burden is of a higher priority and focuses on ability of the firm to meet the principal repayment obligation once the interest obligation is fully met. traditional method of investment appraisals are misleading to a dangerous extent. A means of measuring cash that allows for the importance of time is needed. This is provided by the discounting method of appraisal, of which there are basically two methods, both of which meet the objections to the payback period is the average rate of return method. Now we will talk about the discounting methods of appraisal. The key point is that net present value. The net present value of a project is equal to the sum of present value of all the cash flows associated with the project. One of the most important concepts originating from the time value of money NPV is calculated by subtracting the present value of cash outflow investment from the present value of the cash inflow income. Suppose you are making an investment of rupees 1 lakh today and are expecting that you will get rupees 1.1 lakhs on 1 year from now. You will only invest if the present value of 1.1 lakh is that you are getting 1 year else is more than the rupees 1 lakh you have invested today. Using the table for present value of rupees 1 lakh with 0.909, we get approximate 1 lakh rupees 1 lakhs This means that we are This means that we are getting a return of 10% from the project. If you again look at the same table, the value gets lowered as the interest rate increases, which means that for an interest rate of that more than 10%, we will be getting a present value which will be lower than the investment we are making. So if we are expecting a return of 15% for 1 year, we will not invest at the present value of 1.1 lakhs at 15% discount rate is lower than the investment of rupees 1 lakh we are making today. The formula for calculating the NPV is where NPV is equal to net present value. CF1 is equal to cash flow occurring at the end of year. C0 is equal to initial cash outflow or investment. T is equal to 0 up to n. Cash flow has a positive sign, whereas a cash outflow has a negative. The cash inflow has a positive sign, whereas cash outflow has a negative sign. N is equal to life of the project. K is equal to cost of capital. Is there is a discount rate. Here, C0 is the initial investment we are making into the project, and the rest is the present value of cash flows we are expecting in the future. So NPV is the difference between the two and the expected rate of return. Mm. So NPV is different between the two at the expected rate of return. With NPV is acceptance rule is NPV greater than 0, accept is greater than 0, accept 0 indifferent rather than less than 0 reject. If the NPV is greater than 0, we accept the project because we are getting a rate of return which exceeds our desired rate of return. If it is equal to 0, we know we may or may not accept the project as well as we are getting a return which is exactly equal to our desired rate of return. And if it is less than 0, we reject the if the NPV is greater than 0, we accept the project because we are getting a rate of return which exceeds our desired rate of return. So now we will talk about the features of net present value. two features of the net present value methods to be emphasized. First one is the NPV method is based on the assumption that the intermediate cash inflow of the project is reinvested at the rate of return equal to the firm's cost of capital. The NPV of a simple project monotonically monotonically decreases as the discount rate increases. The decrease in NPV, however, is at decreasing. It is at a decreasing rate. Evaluation. Evaluation. Conceptually sound, the net present value criterion has considerable merits. It takes into account the time of value of money. It considers the cash flow stream in its entirety. It squares neatly with the financial objective of maximization of wealth of stockholder. The net present value represents the contribution of the wealth of stockholders. Now we will talk about the features of net present value. Now we will talk about features of net present value. Two features of the net present value method to be emphasized. The first one is that the NPV method is based on the assumption that the intermediate cash inflows of the project is reinvested at a rate of return equal to the firm's cost of capital. Second is the NPV of a simple project monochronically decrease as the discount rates increase. The decrease in NPV, however, it is a decreasing rate. What is its evolution? Concept, conceptual, conceptually sound. The net present value criterion has a considerable merits. It takes into account the time value of money. Is consider the cash flow stream in its entirely. Entirety. It squares unity with the financial objective of maximization of the wealth of stockholder. The net present value. The present value represents the contribution to the wealth of stockholders. The net present value of various projects measured as they are in today's rupees can be added. For example, the present value of package consisting of two projects A and B is simply be the sum of the net present value of this project individually. NPV multiplied by A plus B is equal to NPV A plus NPV B. The additivity property of net present value ensures that a poor project, one which has a negative net present value, will not be accepted just because it's combined with a good project which has a positive net present value. The limitation of the net present value criteria are the ranking of project on the net present value dimension is influenced by the discount rate. To illustrate, consider two mutually exclusive projects A and B, which have the following cash inflow streams. Here A and B, right? For year 0 it's minus 3,003 lakhs, and for B it's the same as well. For year 1 it's for A, for section A it's 16,000, for B it's 1,30,000. Tick tick tick, you can see the dot dot. The net present value of A and B for various rate of discount is given below. Looking at the behavior of net present value, we find that first one is to find is that when the discount rate is 12%, the net present value of A is greater than the net present value of B. And second one is when the discount rate is 40%, the net present value of B is greater than the net present value of A. net present value measures an absolute measure does not appear very meaningful to businessmen who wants to think in terms of rate of return measures. Now we will talk about another topic. Its core it's as the profitability index. What's profitability index? PI. Profitability index relates the present value of benefits to the initial investment. Profitability index related the present value of benefits to the initial investment. It's also known as benefit cost ratio BCR. PI is equal to PVC is equal to PV is equal to PVCF upon I. The PI is equal to probability index, PVB is equal to present value of cash flow, I is equal to initial investment. To illustrate the calculation of these measures, let us consider a project which is being evaluated by a firm that has a cost of capital of 12%. There are two segments. First one is initial investment, another one is rupees 1 lakh. For year 1 it's 25,000. For 2 it's been 40,000. For year 3 it will be 40,000. And for year 4 it will be 50,000. The probability index for this project is PI is equal to 15,000 25,000 upon 1.121 plus whole plus 40,000 upon 1.12 multiplied by 2 plus 40,000 upon 1.12 1.12 multiplied by 3 plus 50 50,000 upon 1.12 multiplied by 4. This whole uh, whole upon 1 lakhs is equal to 1.1145. With PI, the acceptance rule is PI is greater than 1, except PI is equal to 1, indifferent, PI less than 1 to reject. If Pi is greater than 1, we accept the project because we are getting a rate of return which exceeds our desired rate of return. If it's equal to 1, we may or we may not accept the project as we are getting the return which is exactly equal to our desired rate of return. If it is less than 1, we reject the project proposal because the rate of return we are getting is less than our desired rate of return. What is the evaluation of this one? The proponents of probability index argue that since this criteria says that Since this criterion measures net present value per rupees of outlet, it can discriminate better between large and small investment and hence is preferred to the net present value creation. How validate this argument? Theoretically, it can be very easily verified that under con- uncontested conditions, the pi criteria will accept and reject the same perfect project as, as the net present value criteria. When the capital budget is limited in the current period, the benefit cost ratio criteria may rank projects correctly in the order of decreasingly efficient use of capital. However, its or use is not recommended because it provides no means for aggregating several smaller projects into a package that can be compared with a large project. When cash outflow occurs beyond the current period, pi criteria is unsuitable as a selection criteria. Now we will talk about another topic, internal rate of return. When the present value of cash inflows are exactly equals to the present value cash outflows, we are getting a rate of return which is equal to a discounting rate. In this case, the ratio of return we are getting in the actual return on the project. This rate is called IRR. NPV is equal to sigma n raised to I is equal to 1. CFT upon 1 plus K whole square all square t minus C0. Using the same formula as given in the NPV above, IRR will be the return when the NPV is equal to 0 as only equal to 0 is only then the present value of cash flow inflow will be equal to the present value of the cash outflow. NPV is equal to sigma n dash to I is equal to 1 CFT upon 1 plus R dash to T minus C0 is equal to 0. So the equation is that sigma um, sigma n raised to I is equal to 1 CFT upon 1 plus R raised to T is equal to C0. Here CFT is equal to cash flow at the end of year T. R is equal to discount rate. N is equal to life of the project. In the net present value calculation, we assume that the discount rate is called as the cost of capital is known and determine the net present value of the project. In the internal rate of return, in the internal rate of return calculation, we set the net present value equal to 0 and determine the discount rate, internal rate of return which satisfies this condition. Both the discounting methods NPV and IRR relates the estimates of the annual cash outlays on the investment to the annual net of tax cash receipt generated by the investment. As a general rule, the net of tax cash flow will be composed of revenue less taxes plus depreciation. Since discounting techniques automatically allow for the recovery of the capital outlay in computing time adjusted rates of return, it follows that depreciation provisions implicitly form part of the cash flow inflow. Internal rate of return method consists of finding that rate of discount that reduces the present value of cash flow, both inflow and outflow, attributable to an investment project to 0. In other words, this true rate is that which exactly equalizes the net cash proceeds or a project's life with the initial investment outlay. If the IRR exceeds the financial standard, means cost of capital, then the is uh, project is uh, preface acceptance acceptable instead of being computed on the basis of the average or initial investment. The IRR is based on the funds in use of period to period. The actual calculation of the rate is a hit and miss exercise because the rate is unknown at the outset. But tables of present value are available to aid the analyst. These tables should show the present value of future sums at various rates of discount and are prepared for both single sums and recurring annual payments. What does IRR mean? There are two possible economic interpretations of any internal rate of return. Internal rate of return represent the rate of return on the uncovered investment balance in the project. Internal rate of return is the rate of return earned on initial investment made in the project. What is the evaluation is that? Evaluation, a popular discounted cash flow method. The internal rate of return criteria has several virtues. It takes into account the time value of money. It considers the cash flow stream in its entirety. It makes sense to businessmen who want to think in terms of rate of return and finds an absolute quantity like net present value somewhat difficult to work with. The internal rate of return criteria, however, has its own limitations. It may not be uniquely defined. If the cash flow stream of a project has more than one change in sign, there is a possibility that there are multiple rates of return. The internal rate of return figure cannot distinguish between lending and borrowing, and hence a high internal rate of return not necessarily be a desirable feature. The internal rate of return criteria can be misleading when choosing between mutually exclusive projects that have substantially different outlays. Consider P project Consider project P and Q. Cash outflow period 0, 1. Internal rate of return net present value assuming K is equal to 12%. Both the projects are good, but Q with its higher net present value contributes more to the wealth of the stockholders. Yet from an internal rate of return point of view, P looks better than Q. Hence, the internal rate of return criterion seems unsuitable for ranking projects different of different scale. Comparison of discounting methods. In ordinary circumstances, the two discounting approaches will result in identical investment decisions. However, there are differences between them that can result in conflicting answers in terms of ranking projects according to their probability. The goal. Informal accept or reject decisions.